Hi everyone, this is Dimitri Pergamonic with MarketChameleon.com. I want to go over a scan using a bullish call spread, a vertical call spread, or here we call it a debit long call spread screener. And of course you have a bullish outlook where you're buying a call in the same expiration at one strike and selling a call at a higher strike. So it's a bullish vertical call spread. And we're going to go over a screen to see how we could find potentially good bullish call spreads. And the first thing over here, we see that the expiration, it's automatically set to the next monthly. I'm going to use the next 30 days. And as you see, as I'm using these filters up here, the table below starts to update based on these filters. And you do have multiple filters here that you could switch. And in addition to that, you have different views of data that you could switch down here. I'm going to go back to the summary really quickly, and let's just go over what these in the summary, what the data is in the table, and we'll continue with our screen. So here you see the symbol, stock price, market cap. So all these are right now auto sorted by market cap, but if you click on it, you'll be able to resort the table based on where you click from high to low, from highest to lowest. Let's just resort that. Then over here, this is the market price, the current market price of this debit call spread or bullish call spread. So the expiration is August 23rd. The long strike would be 162.5. The short strike 167.5, and that would be the market price of that. And if you go over here to the market data, you'll see the bid and ask for each of these call options. And here's the market over here. Let's go back to the summary. So we see the market price over here. This is the theoretical value, what we think that this call spread is worth based on the historical stock behavior, and we'll go over that a little bit more. So here we see that there's a negative theoretical edge because this is the market price. If it's worth, when you're buying the call spread, if it's worth below, then you have a negative theoretical edge. Here's the historical win rate based on the current market price. And then over here we have what's your max gain. So if you're paying $4.95 for a $5 call spread, the most you'll make is $5 on that. Here's your downside cushion, meaning that if the stock, which is currently above these strikes, the stock has 4.6% downside cushion, or it could fall 4.6% from here before you break even. So obviously this is all the way in the money right now above the short strike. So you do have some downside cushion, or if the stock sits here, goes higher, or it'll be profitable, or if it even falls down to this strike, it'll still be profitable. And here is your return if the stock just sits here, which is 1%. Basically, you'll return 5 cents on $4.95 worth of risk. So that's what all these data elements are in the summary page. And let's just do a scan here to look for potentially good bullish call spreads. It's also defaulted to the spread between strikes are $5, max of $5. You'll have $1, $2, $3, all the way up to $5, and you could change that, go $0.50, $1. Let's leave that at the max of $5. And here, what's important is, well, let's look for positive theoretical edge. So we want to see call spreads that look good based on the historical data, so they're priced well. I'm going to look for theoretical edge of, let's put 10%, meaning that right here we'll see this table resort, and then you could see here that this call spread right now market price is $4.50. We think the theoretical value is $4.99, so you're buying it below its theoretical value. So you could see that there's at least a 10% edge because you're buying it below the theoretical value. Now let's take another look. We want to see maybe a high win rate based on the current market price. So let's just put it at 70%. So again, we're just narrowing down the possibilities here. You could also just look for stocks in your watch list if you wish, or you could pick stocks maybe that belong to a certain ETF, members of an ETF or sector, and you have all these other options like market cap, average volume, stocks in your 52-week low or high, and you could also use some technical indicators. But let's just move on with this example. Let's say you want a certain cushion, so maybe you want to be conservative and you want to look for a certain cushion to the downside. Maybe you're wrong and the stock doesn't go up, or maybe it does retreat a little bit, and let's just put a cushion of at least 2%. So now we have a downside cushion of at least 2% over here or higher. Now also maybe you want a certain return if the stock just sits here or moves higher, and let's just put that at 15% and see what happens. So over here we could see that even if the stock just sits here, this call spread would be 430 to purchase with a 70-cent max gain. So if the stock just sits here at 120.52 or around here, as long as it's above 115, then you would return 70 cents on $4.30 worth of risk. So that's a 16% return until this expiration, August 16th, which is, let's just take a look real quick. Or actually, we could load this analysis up and it'll tell you 16 trading days to expiration. So the next 16 trading days, that would be the return. The return if the stock just sits here at the same price at expiration. Now let's just maybe even go to higher market cap stocks. So let's try 10 billion just to keep narrowing these down. We do see some earnings in here. Maybe we'll take out the earnings. Could do that over here. So the next earnings dates has to be after expiration. And this is how you would just keep narrowing down your possibilities to try to filter down to what you think potentially is the best opportunity. Now let's take a look at this analysis here. We see this stock. Currently the market price is 425. We think it's worth 467 based on our historical analysis with a 10% edge. And this is based on, let's just look at 4 years of data. Let's change that to 6 years of data. So you could do that from here. Now we narrowed that down further. Now we see Facebook. This call spread is 415, the 190, 195. Currently the stock is 202.43. So if the stock just sits here or goes higher, that's a 20% return by August 23rd. And we think that there's a 10% edge with a historical 91.7% win rate. Let's open this up just to take a look at the data. So we see here the Facebook 190, 195 call spread is $4.15 right now. The stock is 202.43 with 21 trading days to go. We also know that if the stock falls in 21 trading days at expiration, if the stock's below 190 or minus 6.1% below the current price or lower, this call spread will be worthless. It'll be zero because all these calls will be out of the money. So it doesn't matter if the stock's 180, 170, this call spread will be worthless. If it stays above 195 or negative 3.7% or higher from this current stock price, then this call spread is worth $5 because they'll both be in the money, and the 190, 195 call spread is worth $5. If it lands anywhere in between 190 and 195, depending in 21 trading days at expiration, depending where it falls in between here, it'll be worth anywhere between $0 to $5. If the stock's 194, it'll be worth $4. If the stock's 193, it'll be worth $3. So anywhere between this band, minus 6.1% to negative 3.7%, it'll be worth anywhere between $0 to $5. So what we don't know for sure, it's what's the probability of these happening? What's the probability of it going below minus 6.1% in 21 trading days, or staying above negative 3.7% or higher in 21 trading days, or landing in between? And since we don't know that for sure, we go and look at the historical data, what it tells us, and how frequently did this happen. Just like an insurance company, we just look at the historical data to approximate and use that data as a guidance. So in the last 6 years, for a 21-day hold period in Facebook, and we're going to exclude earnings because Facebook does not have earnings coming up now. It just reported. So we're going to exclude earnings periods from the observation. We have 48 total observations, and here's the data. Below minus 6.1%, that happened four times, or 8.3% of the time, and then this call spread will be worth 0 in this situation. Above negative 3.7%, that happened 43 times, or 89.6% of the time, which this call spread would end up being worth $5 at expiration. And then in between, that happened 2.1% of the time for an average return of 4.69%. So then we take all these to see the long-term value. If you did this same spread over and over and over and over again, what would be the average value at expiration? So 8.3% times 0, 2.1% times $4.69, 89.6% times $5. You sum them up, and that's $4.58. So that's how this theoretical value came about. Also, that's how this theoretical came about. Sorry, over here, I was on the wrong one. Also, if you just want to see the data, then you could see the data below for each observation. So from June 24th to July 24th, the stock increased 6.3%. So if it did the same thing this time, the stock, this call spread would be worth $5. From May 23rd to June 24th, increased 6.5%. If it did the same thing, it would be worth $5. So you keep going down the line to see all the data, and that's how we got that summary. That win rate, 91.7%. That's how often historically the spread would have ended up being worth more than the current market price of $4.15. So in this situation, 0, obviously it didn't. Here in this situation, it was $4.69. That's above $4.15. So anything, even a penny above, that's this historical win rate. And that's how you would start using these filters to keep filtering out what you think is potentially the best call spread to do with the screener. Thanks for watching, everyone, and see you in the next video.